Hello and welcome to Chapter 11 of FIN552 Portfolio Selection. In the last chapters, we learned how to price risk and how to diversify. Now we tackle the final practical question: out of all the possible portfolios an investor could build, which single one is truly the best for them? This chapter answers that in two complementary ways. First, Markowitz optimization, which scores any portfolio with a single number called utility, the reward minus a penalty for risk, and picks the highest. Second, Sharpe optimization, a precise three-step recipe that builds the single best risky portfolio from a list of individual stocks and tells you exactly how many ringgit to put in each. By the end, you will be able to compute utility, rank stocks, apply a cutoff, and turn the survivors into exact investment amounts. As always, every term is defined as it appears. Let us begin with a question. Let me start with the central question of this chapter. Imagine you have narrowed your choices down to many possible portfolios, all reasonable. Which single one is truly the best? The surprising answer is that it depends on who is asking, and four ideas build up to it, shown on the cards. The first idea, best for whom, because the best portfolio is not the same for everyone, it depends on each investor's personal appetite for risk. The second idea, measuring satisfaction, where we use a number called utility that scores a portfolio by its reward minus a penalty for the risk it carries. The third idea, Markowitz optimization, the mean-variance approach that simply picks the portfolio with the highest utility. And the fourth idea, Sharpe's optimal mix, a precise step-by-step method that builds the single best risky portfolio from a list of individual stocks. These four ideas are the journey of the chapter. First, let us see who relies on this in the real world. Before the theory, let me show you that portfolio selection is something everyone in investing actually does, every day. Look at the first column, Malaysian institutions. The EPF and KDUAP build optimal portfolios carefully matched to their own risk limits. ASNB and PNB weigh return against risk for their unit trust funds, and fund managers at houses like Kenanga optimize the exact asset weights in every fund. In the middle column, the modern robo-advisors and banks. Apps like Stashaway and Wahid begin by asking you a few questions about your risk tolerance and then pick a suitable portfolio for you automatically. Banks score their clients as risk-averse or risk-taking before advising them, and that risk tolerance, often expressed as a number from 0 to 100, directly drives the recommended mix, which is exactly the idea we will formalize in this chapter. In the third column, global managers. The giants BlackRock and Vanguard run mean-variance optimization as a daily routine. Sharpe ratio optimization is used to build the best risky portfolio, and these methods allocate literally billions across stocks and bonds. The takeaway, every investor, from a pensioner to a sovereign fund, faces the same fundamental task: picking the one portfolio that best fits their own risk appetite. Let us set out what you will be able to do. Here are our 5 learning outcomes, each tagged with its Bloom's taxonomy level. The first, an understand level outcome, is to explain what portfolio selection and optimization actually mean. The second, also understand level, is to describe how an investor's risk tolerance shapes their choice of portfolio. The third, an apply level outcome with real calculation, is to use the utility formula to select the best Markowitz portfolio. The fourth, also apply level, is to carry out the simple Sharpe optimization step by step, the 3-step recipe. And the fifth, an analyze level outcome, is to determine the optimal weights and the exact ringgit invested in each security. Notice the exam tip. The last three outcomes are all calculation based. So this is a numbers heavy chapter. The utility calculation, the sharp steps, and the final weights. I will walk you through everyone. Let me show you the roadmap. Here is our 5-stop journey. Stop 1, selecting a portfolio, where we define what best even means. Stop 2, risk tolerance and utility, where we meet the number that captures an investor's psychology and the formula that scores a portfolio. Stop 3, Markowitz optimization, where we use utility to pick the best ready-made portfolio. Stop 4, Sharpe optimization, the 3-step method to build the best risky portfolio from individual stocks. And stop 5, the payoff, computing the optimal weights and the exact ringgit to invest in each security. The logic moves from the abstract, what makes a portfolio best, all the way to the concrete, how much money goes into each stock. Let us begin at stop 1, the foundations. Welcome to section 1, the foundations. Before any calculation, we must be clear about what we are even trying to do. What does it mean for a portfolio to be the best? In this short section, we will define portfolio selection, define the precise idea of optimization, and lay out the fundamental risk-return trade-off that every choice must navigate. Let us start with what best really means. Let us start by defining what selecting the best portfolio actually means. As the blue box says, it means finding the combination of assets that best matches the risk and return an investor wants, and crucially, their attitude toward risk. 3 things go into that choice, shown in the cards. First, you must match risk and return, balancing the reward you want against the risk you are willing to accept, because the two come together. Second, the portfolio must fit the investor, since the right choice depends entirely on that person's own risk attitude. A cautious retiree and a bold young investor need different portfolios. Third, there are many assets to weigh, so you combine several assets in the precise proportions that suit the goal. The crucial takeaway, and the theme of the whole chapter, is that the best portfolio is not the same for everyone. It must fit the individual investor's risk appetite. Now let us make this idea precise with the concept of optimization. Selecting the best portfolio sounds vague, so let us make it precise with the idea of optimization. Portfolio optimization, in the blue box, is choosing the proportions, the weights of each asset so that the portfolio best meets a goal. For example, the most return for a given level of risk. The formal definition you can write in an exam is determining the weights of securities in a portfolio so it best suits a given objective. 3 features in the cards. First, it is about weights. You decide what percentage of your money goes into each asset. That is the answer optimization produces. Second, it is driven by an objective, a clear goal such as maximizing return for a chosen level of risk. Third, it is a precise method, replacing guesswork and gut feeling with a clear, mathematical optimization rule. The takeaway, optimization, means finding the exact asset weights that best achieve the investor's objective. Both methods we will learn, Markowitz and Sharpe, are ways of doing exactly this. But why is any of this necessary? Because of the fundamental trade-off, which we look at next. Why do we even need to select carefully? Why not just pick the portfolio with the highest return? Because of the eternal trade-off between risk and return, shown on the map. Every portfolio sits somewhere on this risk-return map, with risk along the bottom and return up the side. Investors naturally want high return with low risk, the top left corner. But as the chart shows, that ideal corner is rare. Let us read the 4 quadrants. Top left, low risk and high return. This is the ideal and the rarest. Everyone wants this corner, but it is hard to find. Top right, high risk and high return. This is acceptable for risk takers chasing growth. You pay for the high return with high risk. Bottom left, low risk and low return. This is safe and steady, suiting the cautious investor. And bottom right, high risk and low return. This is simply the worst deal. You would never knowingly choose lots of risk for little return. The dashed line is the typical trade-off, return rising with risk. The takeaway, higher return usually demands higher risk. So portfolio selection is really about finding your own best point on this map, the point that matches your personal appetite for risk. To do that precisely, we turn to Markowitz in Section 2. Section 2 introduces the first method, Markowitz portfolio optimization, also called Mean-Variance theory. The genius of Markowitz was to turn the vague idea of the best portfolio into a single number, called utility, that every investor can compute. Utility rewards return and penalizes risk, and the penalty depends on the investor's own risk tolerance. In this section, we will define utility, learn its formula, understand the risk tolerance scale, and then work through 2 full numerical examples, one for a cautious investor and one for a bold one. Let us begin. Markowitz's mean-variance theory ranks portfolios for each investor using one elegant number, utility. As the blue box says, utility is an investor's total satisfaction from a portfolio, equal to the expected return they enjoy, minus a penalty for the risk they must bear. So it captures both sides of the trade-off in a single score, the good of return and the bad of risk. The theory rests on 2 simple, sensible assumptions about what investors prefer, shown in the cards. First, investors prefer more return, so for the same level of risk, they want the higher expected return, obviously. Second, investors prefer less risk, so for the same level of return, they want the lower standard deviation, the lower risk. Put these together and you get the third card, the rule. The optimal portfolio is simply the one with the greatest utility score, because that is the one giving the most satisfaction once both return and risk are accounted for. The takeaway, utility equals reward minus a risk penalty, and the best portfolio is simply the one with the highest utility. Now let us see the actual formula. Here is the utility formula, built in 2 simple parts. First, on the left, the risk penalty. The penalty for a portfolio's risk is its variance divided by the investor's risk tolerance. Variance, remember, is a measure of how much the return swings the risk. Notice what this fraction does. A bigger variance, more risk, makes a bigger penalty, which is sensible, but a bigger risk tolerance in the denominator shrinks the penalty, because a brave investor is less bothered by risk. Then, on the right, utility itself, which is simply the expected return, E of R, minus that risk penalty. So utility equals E of R minus variance over risk tolerance. The 3 ingredients are in the cards. E of R is the portfolio's expected return, the reward. Variance is how much the return swings the risk, and risk tolerance is the investor's willingness to bear risk on a scale from 0 to 100, which we will discuss next. The crucial insight in the takeaway is that a bigger risk tolerance shrinks the penalty, so a risk taker values a risky but high return portfolio more highly than a cautious investor would. Let us look closely at that risk tolerance number. Let us zoom in on risk tolerance, the number at the heart of the Markowitz method, because it captures the investor's psychology. Risk tolerance, in the blue box, is an investor's willingness to bear more risk in exchange for more return. It is subjective. It reflects each person's individual psychology. There is no right or wrong value. It simply describes who you are as an investor. We measure it on a scale, shown by the colored bar, running from 0 to 100. At the far left, near 0, you are risk averse. Colored green for safe, you strongly dislike risk. In the middle, around 50, you are moderate. And at the far right, near 100, colored red, you are a risk taker, happy to embrace risk for the chance of higher returns. The three cards summarize it. The scale runs from 0 to 100. A low value means risk averse. And remember from the formula, a low risk tolerance in the denominator makes a big risk penalty. A high value means risk taker, and a high tolerance makes a small risk penalty. The takeaway, the smaller the risk tolerance, the more risk averse the investor, and the bigger the penalty, their utility formula charges for risk. This is exactly why the same portfolio can be best for one person and not another. Let us see that on a graph. Let's keep this really simple. This whole slide answers one question. Out of all the good investment mixes a person could buy, which single one should they actually pick? The short answer is, it depends on how much risk that person can stomach. Let me build that up slowly. First, read the graph on the right. The bottom axis, left to right, is risk. Basically, how bumpy and scary the ride is. The side axis, bottom to top, is return, how much money you make. So moving right means more risk, and moving up means more reward. The gold curve is called the efficient frontier. Think of it as a menu of the best possible portfolios. For every level of risk, it shows you the highest return you can possibly get. Nobody can do better than this curve, so any smart investor will pick some point that sits right on it. The dashed lines are called utility curves or indifference curves. Here is the easy way to picture them. Along any one dashed line, the investor feels equally happy at every point on it. They genuinely don't care where on that single line they end up. Same satisfaction everywhere. That is literally why it's called indifference. They're indifferent between those points. Now, the important rule, the higher up a dashed line sits, the happier the investor is. So everyone wants to climb to the highest dashed line they possibly can. Same way you'd always want the top floor of a hotel with the best view. But here's the catch. You can only buy portfolios that actually exist on the gold curve. So the best you can do is reach the highest dashed line that still manages to touch the gold curve. The exact spot where a dashed line just barely touches the gold curve, kissing it at a single point, is called the tangency point. That touching point is this person's perfect portfolio. Higher dashed lines would feel nicer, but they float above the curve, so they're out of reach. Now the interesting part, different people have differently shaped dashed lines. Take investor X, who is risk averse, meaning they hate risk and get nervous easily. Their dashed lines are steep. Steep means that to accept even a tiny bit more risk, X demands a lot more return as a reward. Because the lines are so steep, X's line touches the gold curve early over on the left at a low risk spot. So X ends up choosing a safe, cautious portfolio. Now take investor Y, who is risk tolerant, calm about risk and happy to gamble for bigger gains. Their dashed lines are flat. Flat means Y is willing to take on a lot more risk in exchange for only a little extra return. Because the lines are so flat, Y's line touches the gold curve further to the right at a high risk spot. So Y ends up choosing a bold, higher return portfolio. So, same menu, different choices. X and Y are both staring at the exact same gold curve, but because their feelings about risk are different, Their dashed lines touch the curve in different places. They each walk away with a completely different best portfolio. And both are correct, just correct for different people. One sentence to remember. Your optimal portfolio is the single point where the goal-efficient frontier just touches your highest reachable dash utility curve. There is no universal best portfolio for everyone. The right one depends entirely on how much risk you personally can handle. Now our first numerical work example, computing utility for 5 portfolios when the investor's risk tolerance is 25, a fairly cautious investor. We are given 5 portfolios, A through E, each with its expected return and its variance, shown in the first 3 columns of the table. The formula is utility equals the expected return minus the variance divided by 25, the risk tolerance. Let us work 2 of them, shown in the navy box. For portfolio A, the expected return is 7% and the variance is 80. So the risk penalty is 80 divided by 25, which is 3.2. The utility is therefore 7 minus 3.2, which equals 3.8. For portfolio D, the expected return is 12%, the highest, and the variance is 160, the highest. The risk penalty is 160 divided by 25, which is 6.4, a large penalty. But the utility is 12 minus 6.4, which equals 5.6. We do this for all 5, and the utility column shows the results. A is 3.8, B and C are both 2.4, D is 5.6, and E is 4.8. The winner is portfolio D, with the highest utility of 5.6. Even though D carries the most risk, its high return of 12% outweighs that risk, even for this cautious investor. The takeaway, at a low risk tolerance of 25, portfolio D wins with the highest utility of 5.6. Now let us see what happens when the investor is much bolder. Now the same 5 portfolios, but for a much bolder investor whose risk tolerance is 80 rather than 25. Watch what happens to the penalties. Because we now divide the variance by 80 instead of 25, a much bigger number, every risk penalty shrinks dramatically. For portfolio A, the penalty is now 80 divided by 80, just 1.0, so its utility rises to 6.0. For portfolio D, the penalty is 160 divided by 80, which is only 2.0, far smaller than the 6.4 it suffered before, so D's utility leaps to 10.0. Working through all 5, the utilities are now A6, B 4.88, C 6.25, D 10, and E 8.38. Compare the bar chart on the right. The gold bars for risk tolerance 80 are all taller than the navy bars for 25. Every utility has been lifted because risk is being penalized less. But notice the punchline. Portfolio D still wins with the highest utility of 10. So for both the cautious and the bold investor in this example, D turns out to be best because its high return of 12% outweighs its risk under either tolerance. The takeaway, a higher tolerance lifts every utility, but here portfolio D still wins, its high return outweighs its risk. The Markowitz method ranks ready-made portfolios. But what if we must build the best portfolio from scratch, choosing among individual stocks? For that, we need Sharpe optimization, section 3. Section 3 is the most powerful and the most calculation-heavy part of the chapter. Markowitz let us rank ready-made portfolios, but simple Sharpe optimization does something more ambitious. It builds the single best risky portfolio from scratch, out of a list of individual securities, and tells us exactly how much money to put in each one. It is a clean 3-step recipe, and once you have done it once, it becomes mechanical. We will learn the 3 steps, then work through a complete example investing 5 million ringgit. Take a deep breath and let us begin. Let us meet the Sharpe optimization approach, a more advanced risk-adjusted way to pick the optimal mix of securities. It was developed by the Nobel laureate William Sharpe, the same Sharpe behind the CAPM. The core idea in the blue box is to rank securities by the return each one earns per unit of risk, and then to keep only those that are good enough to belong in the optimal portfolio. 3 features in the cards. First, a risk-adjusted ranking, where we reward each security against the risk it adds, not just its raw return. Second, a cut-off rule, where only securities above a certain threshold make it into the portfolio, the weak ones are dropped. Third, optimal weights, where for the survivors, we compute exactly how much money to put in each one. The takeaway, Sharpe optimization keeps only the securities that pay enough return for the risk they bring. Now, let us see the 3 steps that make it work. Before we dive into the formulas, here is the whole method in one glance, 3 clean steps. Step 1. Rank by excess return to beta. For each security, we measure its extra return per unit of market risk, a risk-adjusted score, and then rank the securities from highest to lowest, best candidates at the top. Step 2. Find the cutoff, called C star. We compute a running C value for each security, and the highest of these becomes the cutoff C star, the bar a security must clear. We keep only the securities whose score is above this cutoff. Step 3. Compute weights and invest. For each surviving security, we compute a Z value, convert those Z values into weights that add up to 100%, and split our money accordingly. The takeaway captures the rhythm, rank, cut off, then weight, 3 steps that take you from a raw list of stocks to a finished optimal portfolio. Let us now work through each step in detail, starting with step 1. Step 1 is to compute the excess return to beta ratio for each security and then rank them. As the blue box explains, this ratio measures the extra return a security earns above the risk-free rate for each unit of non-diversifiable or market risk it carries. The formula in the navy box is the return of the security, R sub I, minus the risk-free rate, R sub F, all divided by the security's beta, beta sub I. Let me define the symbols. R sub I is the rate of return of security I. R sub F is the risk-free rate, and beta sub I is the beta of security I, its market risk. So the top of the fraction, R sub I minus R sub F, is the excess return, the reward above the safe rate, and we divide it by beta, the risk, to get reward per unit of risk. A higher ratio means a security gives more reward for each unit of market risk, making it a stronger candidate for the optimal portfolio. The takeaway, rank every security by this ratio, highest first, so the strongest candidates rise to the top of the list. We will compute this for real stocks shortly. Step 2 decides where to draw the line. Step 2 is where we decide which securities actually make it into the portfolio using a cut-off point. For each security, taken in the ranked order from step 1, we compute a cumulative C value using the formula in the navy box. Do not be intimidated by it. The numerator is the market variance sigma m squared times a running sum of, for each security so far, its excess return times its beta divided by its residual variance, sigma EI squared. The denominator is 1 plus the market variance times a running sum of, for each security so far, its beta squared divided by its residual variance. The keyword is cumulative. You add one more securities terms each time you move down the ranked list, so each C value builds on the previous ones. Now the rule in the 3 points. First, rearrange the securities from highest to lowest excess return to beta, the ranking from step 1. Second, find the highest C value among them, and that peak value becomes the cutoff point, called C star. Third, keep only those securities whose excess return to beta ratio is above C star. The takeaway, a security joins the optimal portfolio only if its excess return to beta ratio is higher than the cutoff C star. The residual variance, by the way, sigma EI squared, is just the company-specific risk of security I. Once we know who is in, step 3 tells us how much of each to buy. Step 3 turns the surviving securities into exact proportions, the answer we have been working towards. First, for each chosen security, we compute its z-value using the formula on the left. The z-value is the security's beta divided by its residual variance, sigma EI squared, multiplied by, in brackets, its excess return to beta ratio minus the cutoff C star. So the bigger a securities ratio sits above the cutoff, the bigger its Z value, and the more of it we will hold. Then, on the right, we convert these Z values into weights. The weight of security I, W sub I, is simply its Z value divided by the sum of all the Z values. Dividing by the total, like this, guarantees the weights add up to 100%, a complete portfolio. The box at the bottom explains what the weights mean in practice. Each weight is the fraction of your money to invest in that security, and if you multiply each weight by your total funds, you get the exact ringgit amount to put into each one. The takeaway, the weights tell you exactly what proportion of your money goes into each chosen security. Now let us run the entire 3-step method on a real example with real numbers and 5 million ringgit to invest. Let us run the full Sharpe method on a real example. The given information at the top, the treasury bill rate, our risk-free rate is 4%. The expected market return is 12%. The market variance is 20, and we have 5 million ringgit to invest across whichever stocks make the cut. We are given 4 stocks, A, B, C, and D, each with its expected return, its beta, and its residual variance, which is its company-specific risk. Step 1, compute the excess return to beta ratio for each. That is the return minus 4% divided by the beta. For stock A, 11 minus 4 is 7, divided by beta 1.1, gives 6.36. For stock B, 13 minus 4 is 9, divided by 0.3 gives 30. For stock C, 9 minus 4 is 5, divided by 0.5 gives 10. And for stock D, 10 minus 4 is 6, divided by 0.1, the smallest beta, gives a huge 60. Now we rank them highest to lowest, D first at 60, then B at 30, then C at 10, and last A at 6.36. The result in the box is this ranked order, D, B, C, A, which we will carry into step 2 to find the cutoff. Notice that stock D, despite a modest return, ranks highest because its beta is tiny. It earns its return with very little market risk. Step 2. We compute the cumulative C values working down the ranked list D, B, C, A and find the cutoff. I will not read out every term of the C value formula, but the table shows the result for each stock. Remember, each C value is cumulative, building on the stocks above it using the market variance of 20. For stock D alone, the C value is 3.75. Adding stock B, it rises to 8.85. Adding stock C, it rises further to 9.60, and adding stock A, it actually falls back to 7.79. Now find the highest C value, which occurs at stock C, 9.60. That peak value is our cutoff C star, equal to 9.60. The rule is to keep only securities whose excess return to beta ratio is above this cutoff. Check each. This ratio of 60 is above 9.6, in. B's 30 is above, in. C's 10 is above 9.6, just barely, in. But A's ratio of 6.36 is below 9.6, so stock A is dropped. It does not earn enough return for the risk it brings. The result, in the box, our optimal portfolio will contain stocks D, B, and C, while A is excluded. Now step 3 tells us how much of each to buy. Step 3. The final payoff, we turn the 3 surviving stocks into exact ringgit amounts. First, we compute each stock's Z value using the formula from earlier, the beta over residual variance times the gap between its ratio and the cutoff. The Z values come out as, for D 1.680, for B 0.874, and for C just 0.100, small, because C's ratio of 10 was barely above the cutoff of 9.6. These Z values sum to 2.654. Now the weights, each weight is the stock's Z value divided by that total. For D, 1.68 divided by 2.654 gives 0.633, so 63.3%. For B, 0.874 over the total gives 0.329, 32.9%. And for C, 0.1 over the total gives 0.038, just 3.8%. The weights add up to 100%, a complete portfolio shown in the donut chart. Finally, multiply each weight by the 5 million ringgit to get the investment. D gets 0.633 times 5 million, which is 3,165,000 ringgit. B gets 1,645,000 and C gets 190,000. These three add up to exactly 5 million ringgit. The final answer, in the box, invest mostly in D, then B, with a little in C. And there you have it, a finished optimal portfolio built from scratch. Let us compare the two methods we have learned. We have now learned two methods for portfolio selection, so let us compare them clearly, because each suits a different situation. Read down the table. Their goals differ. The Markowitz utility method picks the portfolio with the highest utility from a set of ready-made portfolios, while Simple Sharpe builds the optimal risky portfolio from scratch out of many individual stocks. Their key inputs differ. Markowitz needs the investor's risk tolerance, while Sharpe needs each security's excess return to beta. The risk measures differ. Markowitz uses the variance of the whole portfolio, while Sharpe uses beta and residual variance under the single index model. The outputs differ. Markowitz gives you the single best ready-made portfolio, while Sharpe gives you the optimal weights for each chosen security, and they are best in different situations. Markowitz, when you are comparing whole portfolios that already exist, Sharpe when you are choosing which individual stocks to combine into a new one. The takeaway, use the utility method to rank ready-made portfolios by an investor's risk tolerance, and use Sharpe optimization to build a portfolio from individual stocks. They are complementary tools, not rivals. Let us bring the whole chapter together on one page. Here is the whole chapter on a single page, your revision map. At the top, our subject, Chapter 11, Portfolio Selection. Everything flows into three pillars. The first pillar, Foundations, covers what it means to select the best portfolio, the idea that optimization means choosing the weights, and the risk-return rationale, the trade-off every investor faces. The second pillar, Markowitz, covers the utility formula, expected return minus a risk penalty, the risk tolerance scale from 0 to 100, and the rule that the highest utility portfolio wins. The third pillar, Sharpe optimization, covers the three-step method, ranking securities by excess return to beta using the cut-off C star to select which securities are in, and turning Z values into weights and finally into ringgit. And along the bottom, the single goal that ties it all together, to match the right portfolio to the right investor, precisely. If you can compute utility, run the three Sharpe steps, and turn the result into weights and ringgit, you have mastered this chapter. Let me close with a final word. And that brings us to the end of Chapter 11, Portfolio Selection. You have learned how to choose and even to build the single best portfolio for any investor. Questions are very welcome, so as I like to say, let us build the best portfolio together. Bring me anything that is unclear. Before you sit the exam, make sure you can do three things listed in the box. First, compute utility, expected return minus variance over risk tolerance, and use it to pick the best Markowitz portfolio. Second, rank securities by their excess return to beta ratio and apply the cut-off C star to decide which securities make the portfolio. And third, turn the Z values into weights and then into the exact ringgit invested in each security. Practice the two utility examples and the full 5 million ringgit Sharpe example until they are second nature. If you can do all of that, you can take a list of stocks and an investor's risk appetite and produce a precise optimal portfolio, which is exactly what professional fund managers and robo-advisors do every day. Thank you so much for your attention throughout this course. Take care and happy investing.